Hello everyone, and welcome to another episode of the Daily Gwei Refuel, where we recap the latest news in the Ethereum ecosystem. I'm your host, Anthony Sassano, and today's the 23rd of September, 2022. Alright everyone, let's get into it. So some fresh regulatory news out today that isn't actually positive. It's actually quite negative. Now, this was announced on Twitter by a bunch of various people, but this tweet from DB reads, the Commission defines the UKI DAO unincorporated association as those holders of UKI tokens that have voted on governance proposals with respect to running the business. If you are a UKI token holder who voted on governance proposals, you just got charged. So the original kind of thing here is that the CFTC is charging the UKI DAO, which I believe was BZX before it was called UKI, for the offering of illegal off-exchange digital asset trading, registration violations, and failing to comply with the Bank Secrecy Act. This is obviously pretty serious charges here, but in their kind of charges, they also define the people who are holding the governance tokens and have used those governance tokens to vote on things as people that can be charged as well here, which obviously doesn't really make much sense. It's a big overreach, and this is disappointing coming from the CFTC, who have traditionally been, I guess, more friendly than the SEC at least, but it seems they're all going down the same path now, where they're trying to, I guess, use as much power as they can, even if they don't have that power, to go after things like DeFi. And we all knew this was coming, right? Like, we all knew that DeFi's, I guess, regulatory issues were only going to get worse from here, but this sort of stuff is just way overstepping, right? It just doesn't really make any sense. And there's a few takes here from some lawyers. First one from Jake Travinsky, who said, the CFTC's BZX enforcement action may be the most egregious example of regulation by enforcement in the history of crypto. We've complained at length about the SEC abusing this tactic, but the CFTC has put them to shame. And you can read Commissioner's Mersinger dissent here as well, which I'll link in the YouTube description. And then Jake continues by saying, it's deeply disappointing to see the CFTC damage its own reputation like this among those who care about the future of crypto in the United States, especially at a critical moment where, while it pitches itself in Congress as the right agency to regulate quote-unquote digital commodity trades. So, I mean, I totally agree with Jake. It's very disappointing here. And where he says, you know, this is regulation by enforcement rather than regulation via kind of the traditional and the proper means through the law and things like that. What he's basically saying is that this is kind of going to lead to a chilling effect. I mean, the goal would probably be that chilling effect, where the same is with OFAC, where they went after Tornado Cash. They wanted to put a chilling effect on mixers on Ethereum, right? And for people using that mixer. So the same is true with this, is it seems like the CFTC is coming hard against a small player like UKI or BZX. They're very small actually now. They used to be a lot bigger back in the day, but they're tiny now because BZX's history is pretty bad actually. I think they've been hacked like 3 times. They just didn't really ever get product market fit, and now they're being charged with this. So what ends up happening is that they go after the smaller players because they're the ones who can't fight back, right? Can't afford the nice fancy lawyers, can't afford to kind of go through all the motions to fight back against this. And then that leads to a chilling effect for all the bigger players, or leads to essentially these bigger players over complying, or, you know, complying way more than they should, sort of what we saw like with the OFAC sanctions. And I think that because the OFAC sanctions seem to have worked so well, at least temporarily, these other agencies are probably looking at that and being like, wow, okay, you know, these guys are just going to fall over. These guys are just pushovers. We can just do regulation via enforcement without having to actually prove any wrongdoing or have to go to court or, you know, settle with lawyers. We can just scare everyone into compliance. That is a really shitty thing to do, but not surprising. And also, I don't think it's going to work long term. It'll for sure work short term, but what'll end up happening is if they keep going down this road, these institutions and regulatory bodies keep going down this road of enforcement enforcement example of regulation by enforcement. Sorry, I should say. What's going to end up happening is that a lot of people, businesses, DAOs, whatever you want to call them, are going to leave the US. They're going to go somewhere else which is more friendly to them, and that's going to be a huge blow to the US because we all believe that crypto is the future of not only finance, but of a lot of different things within a lot of different industries. And if the US wants to take such a hardline stance against that and scare off all the talent, well, that's very bearish for the US's kind of outlook within crypto. Now, as I said, this is a short-term thing in terms of it working. So medium to long-term, it would result in that. Or these agencies basically, they try this and then it doesn't work, and then they maybe play play fairer, but I don't know. I don't really trust any of these agencies to do that, and this is just very, very disappointing. And there's a couple of other tweets here. One here from a Twitter account called Chairman Burb Bernanke, who said the CFTC themselves has never defined a DAO this way. This is the first instance even Masinga can find of this definition. I don't think this is how the law should work. This is an admission that you can be charged with a crime that's only defined when you're charged. Now, that's a key point there. Now, basically, the way they've defined a DAO here is that the DAO isn't defined as any one token holder, but as anyone who voted during a time period. This means you can be in the DAO by being a token holder, but if you vote for anything such as a higher interest rate, then only then are you liable. So this is really like stupid, and as they pointed out here, this is an admission that you can be charged with a crime that's only defined when you're charged, which is obviously not a fair way to do justice. It doesn't make any sense, and it is, again, a massive overreach here. So I think that all in all, this is very, I mean, I wouldn't say it's bearish or scary or anything for DeFi. I would say it's concerning in that these regulators are trying everything they can, it seems, to come down on crypto without actually having the power to do so. They're trying to do that chilling effect. They're trying to scare people. And I mean, it worked for OFAC, so the SEC and the CFTC are probably looking and being like, okay, well, let's just do the same thing. Let's just scare people into compliance, scare people into over-compliance. And to their, I guess, credit on this, like, I mean, a lot of DeFi is easily scared, especially the DeFi projects that are based in the US. The team members obviously don't want to fall afoul of the law at all, and they've got lawyers and stuff, but still, they don't want to have to spend time on that, so they definitely over-comply when they shouldn't. And last up here is a tweet from Drew Hinks about this, who says CFTC brings, he just basically announced it, first regulatory action against a DAO. So charging UkiDAO with operating an unlicensed FCM, seeking disgorgement, restitution, civil monetary penalties, trading and registration bans, and injunctive relief. This is, these are obviously very serious charges, and they've kind of gone the full 9 yards here, and they're doing it against a DAO as well. And as I said, they defined a DAO as basically the token holders who vote on things, not just the token holders themselves, but you have to actually actively participate in governance. And what I find hilarious about this is that most of the people who hold these tokens never ever participate in governance, and that's not because of legal liability, at least not for most people. It's because they just don't care to, right? And this is just going to actually have a more chilling effect and make people not want to do it because in case they are breaking a law here. But the way I view this is, it's basically, as I said, again, it's basically trying to do that chilling effect, but the chances of you getting in trouble for voting on something and in a DAO is the same chances of you getting in trouble for pirating copyrighted content, right? Like, it's just, in theory, I mean, yeah, you may be doing something wrong, but in practice, you're probably not going to get prosecuted for it or get anyone coming after you. They usually go after the source, in the terms of pirated content, they usually go after the distributors. And then in terms of a DAO, they would probably go after the people actually building the, I guess, DeFi app that is associated with the DAO, because it's just a better way to do it, and it's basically impossible to go after every single little individual, right? But still, concerning, not great. I think that we're going to have to just see how this folds out over the next few years. There's going to be fighting over this potentially in the courts, but outside of the courts between lawyers. And I mean, at the end of the day, the winners from this are the lawyers. Like, all the DeFi teams are probably like, holy shit, I need to be prepared for this. I need to probably get lawyers, all these sorts of stuff. But we'll have to see what happens there. But on that note, there was some positive news over the last 24 hours on the regulatory front, which I guess is related to the regulatory front, and that is that GitHub unbanned the Tornado Cash organization and contributors on their platform, which means that the Tornado Cash code is now live on GitHub again, which is awesome. Obviously, I remember I spoke about this when OFAC sanctioned Tornado Cash the first time, and GitHub was very, very quick to take it down because of the fact that it was on the sanctions list. Now, the code itself, OFAC actually stated that here on the 14th of September, that US persons are not prohibited by US sanctions regulations from copying the open source code and making it available online for others to view, which means that GitHub is not liable if it's on their website because it's not actually illegal for them to do that. So it's really, really cool to see that they've unbanned it now. It's still, I mean, look, GitHub is obviously a pretty big centralized point of failure for a lot of our industry because everyone uses it to store code. And yeah, okay, it's open source, but I mean, at the click of a button, they can remove that from their platform. So we definitely need to still kind of encourage these centralized versions of GitHub or putting code in multiple places, not just on one mega centralized website, because GitHub is owned by Microsoft, for those of you who didn't know. So obviously one of the most centralized and US-centric companies in the world that is definitely not going to fight for us, right? Because our industry is still so small comparatively, but also we should just have the code on multiple different places. But still cool to see that this was unbanned. As I said, some light positive regulatory news in the face of that really shitty CFTC news over the last 24 hours. All right, so Terrence from the Prior Labs team tweeted out, 1 week since the merge, everyone around me is just working on withdrawals and 4844. Can devs take a break, please? I remember I said, after the merge that, or leading up to the merge, that the devs were actually going to take a 4 to 5 week break until after DevCon, in order to recharge their batteries. But as I said before, it seems like they are so, I guess, like there's so much momentum after the merge, and they feel so, I guess, motivated to keep working on stuff that they're still working on withdrawals and 4844, which are both tentatively scheduled to go into the Shanghai update, which is absolutely awesome. I mean, both of these things are major upgrades, right? I mean, technically, withdrawals being enabled isn't a quote-unquote upgrade, but it's a feature that is needed to complete that loop of proof of stake Ethereum. You know, some could argue that, I mean, you could make the argument that Ethereum is not a 100% full proof of stake network as it exists today because we don't have withdrawals enabled, and it limits the network still. And I would actually agree with that argument. So that's obviously coming as soon as it can. And then 4844 is that proto-dank sharding, which may not seem urgent right now considering demand is quite low. Gas fees on layer 1 are low, which means gas fees on layer 2s are low, and layer 2s are scaling in their own ways as well, independent of layer 1. But we still want to get that ship. We still want to get that on the network because that future-proofs the scalability of Ethereum for quite a while. And when the demand does come back, and we do have a lot of new users coming back, they're not going to have to contend with Ethereum layer 1's exorbitant gas fees because the gas fees are going to go back up. Definitely. I have no doubt about that. Just because people are on layer 2s instead of layer 1s doesn't mean there's still not going to be plenty of people on layer 1. There is still like $50 billion of TVL, even at these depressed prices, on layer 1. So there's still a ton of activity on there. And so the fees are going to go back up. But because we have these layer 2s live and they have ecosystems built out as well, they're going to be the preferred place for people to go that don't want to or don't have the ability to pay those high gas fees. And nor should they have to pay those high gas fees. So I'm obviously looking forward to both of these for completely different reasons. I'm looking forward to withdrawals because I want us to close that loop and also enable people to withdraw from somewhere where they're not comfortable staking anymore and go stake with another provider. Maybe they staked with Lido originally, and now they want to change to Rockerpool because when they staked with Lido, Rockerpool wasn't out, right? And maybe they don't want to take that haircut from selling the ST, which isn't actually too bad these days, but maybe they would just rather withdraw everything that they have from the beacon chain itself, or maybe they staked with Coinbase and want to go to Rockerpool, or maybe they stacked enough ETH during the bear market that they want to become a solo staker now, and originally they put their ETH into Coinbase. Maybe they put like 20 ETH into Coinbase because that's all they had at the time, and then they were able to stack more, and now they have the 32 ETH necessary to solo stake, and then they're going to go do that. Or maybe people have just seen all the OFAC stuff and been like, holy shit, like I need to get my ETH off these centralized places because it's at risk of social slashing. It's a bigger risk than going with a solo staker or a decentralized pool such as Rockerpool. So we're going to see that great reshuffling with withdrawals, but I definitely want to see that as soon as possible. And obviously 4844 proto-dank sharding speaks for itself at this point because I've spoken about it so many times, but we need that as well to go into the network to future-proof Ethereum scalability for, I guess, I don't know how long it would future-proof us for. It just depends on the kind of demand that we get and the kind of applications that get built, but it does give us, at least 1 to 2 years, I would say, at least, and it shifts the scalability to layer 2s from there. So layer 2s will have a lot of the work that they're doing on their own to upgrade their own networks, and that would feed into the upgrades they get from 4844 as well. All right, so Etherumpools.info put out another great tweet thread today. They said, some research on Ethereum multi-block MEV. How likely is it for a pool controlling P% of the validators to propose K consecutive blocks in an epoch? So, i.e., Kraken will propose 5 consecutive blocks once a month on average, but don't trust a random tweet. More info. So there's a thread here about this, and I like where they said, but basically, I like the table that they've got here, where they show what the chances are. And I've spoken about multi-block MEV before. As you guys know, in Proof of Stake, the next block proposer is known. So everyone on the network or everyone viewing the network can know who the next proposer is. And if you know that you're going to propose consecutive blocks, well, then you can do multi-block MEV. So for example, within an epoch, all 32 block proposers are known in advance. And this is new in Proof of Stake and enables new ways of MEV, of course, such as manipulating TWAP or time-weighted average price oracles. Now, if you are a Coinbase or a Kraken or some entity that has a lot of stake, and say you see within those 32 block proposers that you have a window where you are the next 5 block proposers, well, you could technically come up with a strategy that takes advantage of that with multi-block MEV. And essentially, you can control which transactions go into which blocks in those 5 blocks in order to get the most MEV profit possible out of that. Now, in practice, we haven't seen this yet. This thread goes through that, which you can, I'll link it in the YouTube description below for you to check out. In practice, we haven't seen any of this right now, and you have to be quite a large entity to actually propose blocks like that consecutively. I mean, you basically have to be one of the top ones here, Coinbase, Kraken, or Binance, and then after that, it's kind of very hard because Lido, even though Lido has 30% of the network, or a little bit under 30% actually right now, the operators are who are proposing the blocks. Lido themselves isn't a monolithic operator. They have those 28, 29, I think it's actually up to 30 now, operators that are proposing the blocks. So unless they collude to do something, because these operators are independent, unless they collude, it's not going to happen under Lido. But when it is a single entity like Coinbase, Kraken, Binance, and a few of the others on this list, then of course it becomes more of an issue. But in saying that, like, we're only at the start of a potential multi-block MEV world, and I don't think there's many people out there who actually know what strategies to run in order to do this. And you can imagine if a Coinbase or a Kraken or a Binance starts doing this, they're going to get publicly shamed for it, and maybe they're going to lose stake. So maybe it's actually in their best interest to not do any multi-block MEV, even though the profits would be larger. And just because that could potentially lead to an outflow of ETH staked on their platform, and then obviously less fees for the ETH that they already have staked with them, and that could net out to actually a negative, and the negative press would be pretty bad for them as well. So there are things here that prevent them from doing this, but we shouldn't just rely on that, and that's why we're obviously working a lot of ways to minimize MEV as much as possible, and we're obviously working on SSLE so that you basically don't know who the next block proposers are going to be in the beacon chain, which is very important. I guess not just for MEV, but also for DOS risks. So, for example, if you know that Binance, Kraken, Coinbase, or whatever are going to propose, the next block or the next X amount of blocks, you can potentially DOS them and prevent them from doing that. So there's griefing attacks and things like that. Obviously, it's quite difficult, but still, we want to. The way we operate in Ethereum is we always think of like the worst case scenarios and build around that. That's the strength of Ethereum, is that, and that's why things take so long, is because we don't want to just settle for the maybe scenario, right? We want to settle for okay, this is the worst case scenario, and this, there's a 100% chance of this happening. How do we prepare for it? Because at the end of the day, even if the chance of it happening is basically 0%, it doesn't matter. We need to go in with the assumption that there is a 100% chance of this happening at some point in the next, 10, 20, 100 years. Like, Ethereum is trying to build itself to be a network that is resilient for centuries, for thousands of years potentially, right? Like that is literally what we're building Ethereum as, a network that is resilient for that long. And in that world, we have to consider all of these possibilities and work to minimize the risk of them happening or to eliminate them altogether. So that's what I've always loved about Ethereum, and I think that we've still got that ethos and we're still building with that in mind, and I don't think that's going to change. I really do think that everyone on the core protocol side of things understands this and wants to build for that. So that's really promising. But I'll link this Etherumpools.info thread in the YouTube description below, and you can go check that one out. All right, so speaking of Ethereum core development, Francesco here has published a new post on the ETH research forum called View Merge as a replacement for Proposer Boost. Now, this is a long and technical post here, but you may be familiar with Proposer Boost, which was basically one of those fixes that was put in place in order to prevent manipulation of the fork choice rule of Ethereum and cause the chain to kind of like split up and things like that. So this is a proposal called View Merge that would replace Proposer Boost. And it seems pretty promising from my reading. This thread does a good job of breaking it down and how it all works, but I just wanted to put it on your radar because I think it's very important, because Proposer Boost was like more of a band-aid solution than a permanent one, and if we can come up with better solutions, then definitely we want to get them into the network. So I'll link this in the YouTube description below for you to check out. All right, this is different. This isn't called Protocol Work. So I came across this project today called, I'm going to butcher the pronunciation here. It's called Arcticium. Yeah, I think that's how you say it. Which is a fully on-chain and permissionless P2P NFT marketplace on Starknet, and now they're live on the Starknet Girly testnet. So you can check out their 101 article here to learn all about what they're building. But yeah, as I said, I just came across this project today. I don't know much about it. I can't vouch for it or anything like that. But I just wanted to put it on your radar because it's another project that's gone live on Starknet and is obviously live on the testnet right now, but will hopefully be live on mainnet sooner rather than later. So I'll link this in the YouTube description and you can go check it out. All right, so Aztec announced today that they've recently made an upgrade to the Aztec platform that removes a layer of trust from the Aztec core team, which is the subsidy contract. So now it allows any party to fund subsidies for bridge transactions and bootstrap volume on Aztec. Take, for example, a bridge that supports 50 unit transaction batches. Think of it like a bus with 50 seats, which only departs for its destination once the bus is full. On any given day, three things could happen. All 50 seats get filled and the bus leaves. Yay, not all 50 seats get filled and people wait for a bit before the rest of the seats get filled. Or someone at some point gets sick of waiting and pays for the whole bus to go down to Ethereum and execute. The someone in three scenarios could be an individual, the bus service itself, and the bus service itself. Protocols who want their bridges to be performant even before bus seats are selling out can subsidize regular departures, ensuring timely performance. So previously, Aztec did these subsidies for people, but now it seems that a contract has been deployed that allows any EOA, which is just a normal Ethereum address, or contract account to subsidize bridge contracts under a certain set of parameters: bridge ID, subsidy amount committed, and bridge contract backstop. So you can read the thread for full details on this, but this is very cool. I've talked about this before. I think I haven't talked about it in a little while now, but basically this thing where we would have teams and projects subsidizing people to bridge into layer 2s from layer 1. Obviously, these days, it's not as important because layer 1 fees are quite low. But as I said before, we expect layer 1 fees to go up again. So when that happens, the subsidies are going to be even more important. Now, we obviously don't want to just limit this to the teams themselves having to do the subsidies, but anyone can do it. And anyone could do it for any reason. I would imagine that projects on these networks would want to do it to encourage users to onboard to their project and subsidy through that way. But as Aztec said here, anyone can do this with their tooling. With the contracts that they've deployed. Now, I hope to see this on not just Aztec but all the other layer 2 networks out there. I hope to see some centralized exchanges doing this. That'd be really cool. Not sure what they would get out of that. Maybe they do it and then kind of take a cut if someone uses a DeFi protocol because they have like a front end for it. I'm not sure what it would look like in practice, but they could do it for their users. So, but they would want to obviously be making money out of it because subsidizing means they're at a net loss if they're not making money out of it in some way. But the layer 2s are definitely motivated to get people onto their ecosystem because in the long run, it makes them money. It's kind of like how PayPal originally did that thing where they gave, I can't remember the exact amount, it was like $10 or $15 to all people that signed up for a new account. And it's kind of like how banks do teaser rates and things like that. So that's just to get customers in the door. And obviously you don't expect 100% of the customers to stick around, but the percentage that do stick around make up for the ones that don't over the lifetime of their usage of the platform. So the same is true for DeFi apps, layer 2s, whoever it is. Subsidies can work if done correctly. All right, so an announcement here from Eth.limo today. So the Eth.limo ENS gateway now supports Arweave and IPFS swarm content hashes. Users can now utilize every ENS-compatible storage layer: IPFS, IPNS, Swarm, Skynet, and Arweave. This is very cool. I think obviously this is much more important these days than it's been in the past, especially in the age of the OFAC sanctions on Tornado Cash and also these other regulatory things that have been coming down the pipeline lately. So yeah, I always want to encourage projects that are doing this because at the end of the day, every front end in DeFi should be on these platforms, should be on one of these platforms at least to fight off against any centralization concerns. So great job here from Eth.limo today. All right, last up here before I go into a bullish rant. So you guys are going to be excited about this one. Just a shout out to the ETH Global here, who is doing an Optimism summit, which has been, I believe it's already finished, that you can go view on. But there's a lot of people talking as part of this summit, or people that did talk as part of this summit around all things Optimism, but also Ethereum Layer 1, the modular OP stack, everything around that. So I just wanted to give a shout out to this. You guys can go give it a view. I'll link it in the YouTube description below. But finally, to end off today's episode and to get you bullish into the weekend, I have a tweet thread that I put out just before, talking about a week since the merge and how that's affected ETH issuance. So it's been a little over a week since the merge, right? If Ethereum was still on proof of work, the supply of ETH would have gone up by about 100,000. And this is factoring in the burn as well. But because we're obviously on proof of stake, the supply of ETH has only gone up by 5,000. This is a 95% reduction in net ETH issuance, obviously including the burn, as I mentioned. That is more than the triple halvening, because the triple halvening only ever accounted for the block reward issuance, or the protocol issuance, I should say. It didn't factor in the burn. Now, this is a 95% reduction with the burn being not deflationary because the gas fees are so low, right? But this is huge. Think about that for a second. 95%, right? That's a massive reduction. Now, in further tweets, I put numbers to this, right? Dollar numbers to this. So I said we can extrapolate this out to a year's worth of issuance. Remember, this is only 1 week. So I did a naive math on this, and I just times that by 52 weeks. It would have been 5.2 million ETH under proof of work in a year. It's only 260,000 ETH under proof of stake. Again, this is including the burn. In dollar terms, at the current price, that is $7 billion under proof of work and only $350 million under proof of stake. And again, this is over a year period, guys. Like this is absolutely massive, the reduction, especially when you put a dollar value to it. If we want to go to the all-time high and put a dollar value to it, well, what we would need to do is we would go 5.2 million. I didn't do this before, but I'll just do it quickly now. Times $5,000, which is around the all-time high. That was $26 billion a year of proof of work issuance that was needed to be eaten up just to keep the price at flat, basically. Just to keep the price flat. We needed even more than that for the price to go up, right? Now, let's do that at $5,000 in a proof of stake world of 260,000 times 5,000. That's only 1,300,000,000. So 1.3 billion as opposed to 26 billion, right? Massive, massive reduction there. Now, I went on and continued and I said, I'm going to make you even more bullish. Most of that proof of work issuance was probably dumped by miners since they had to cover operating costs. And it definitely was. I mean, it was not a probably. I don't know why I used the word probably there. It definitely was dumped by miners to cover those operating costs. But on top of the operating costs, they also want to take profit for themselves, right? Like, it's not just I'm a miner, I'm just going to pay for my operating costs and then keep the rest of the ETH forever. No, they're going to sell it for profit. And some miners even held onto it to stake it, which is even better. But most of the proof of stake issuance after taxes will probably be held restaked since operating costs are significantly lower than proof of work. And I've talked about this lots on the refill before. You guys know all about this. And then I said in the last tweet, once the market heats up again and average gas prices are back at only 15 Gwei plus, because that's the current ultrasound barrier, the issuance will be net negative. Of course, as more ETH is staked, the higher gas price we need to keep ETH deflationary, but more ETH staked is good for the price as well. So, and you get where I'm going with that, right? I've gone through this before, but there is such a beautiful feedback loop here with the way the entire Ethereum monetary policy works. I don't think we're perfect yet. I do think that obviously the merge and 1559 are the core pieces of each monetary policy. There's probably going to be some tweaks to it in the future, specifically around things like capping the maximum amount of active validators on the network at once. So aka the maximum amount of ETH that is staked actively on the network at once. That's been talked about, and I've mentioned it before. And then I think there's one other thing that I'm forgetting right now. But as it currently stands, this is just stupidly insane. Now, if you want to compare this to something like Bitcoin, right, we can go back to our favorite site, moneyprinter.info, which I've talked about before. So moneyprinter.info, I believe, factors in the burn as well here. And oh man, Ethereum's not on this at the moment. Damn. Okay, I saw it the other day, so I can say what it is. So we can look at the issuance of Bitcoin right now, daily issuance. $17.6 million is issued to miners, which has to be sold. Then we can look at Solana, $3.2 million. it's not issued to miners, it's issued to stakers, but still, it's quite a lot. But Avalanche, 1.1 million, and these Solana and Avalanche both have much lower market caps than Bitcoin and Ethereum as well, right? So if you kind of factor that into it as well, it's actually on a market cap basis a lot of issuance. And then I think ETH fell actually under Dogecoin. Dogecoin is currently paying $800,000 a day to secure its network. Now I think Ethereum was just under 800,000, including the burn, at around 0.17% issuance rate. That is insane. Like, I mean, that is a crazy amount. That's like 20 times less than Bitcoin, guys. And so I know people have looked at the price recently, especially the ETH BTC ratio, and thought to themselves, well, if it's so bullish, why did ETH BTC go down? Because short-term is irrelevant. Short-term is always dictated by short-term narratives and traders. The medium to long-term is where you're going to see the effect of this issuance reduction play out. And I've gone through this plenty of times before, and I sound like a broken record at this point, but you're going to see it play out over the longer term. I'm not going to promise you that. I'm not going to guarantee you that, but I truly do believe that these flow changes are going to have an absolutely massive impact in demand periods. Because instead of requiring $26 billion a year, right, if ETH was $5,000 to secure to make up for the miner dumping, we would need a considerable less amount of that. So just naturally, because of that, ETH should trade lighter. Like, I mean, the math adds up, right? This is and the logic adds up. This is not something where I'm living in fantasy land and I'm making up fantasy things. If the demand is there, like, imagine if the demand was, I think I mentioned this yesterday, the demand doesn't even have to be anywhere near the same as it was during last year or the year before. Well, I guess probably last year is better. It can be less than it was then, and ETH should trade light up just based on that massive change in the flows there. So hopefully that little rant there has made you bullish into the weekend. I know I am. I mean, you guys know I'm still buying ETH, like, especially at these prices where I feel like it's a bargain bin prices. Can it go lower? Of course it can. The macro environment's still really shitty. We don't know what's going to happen with inflation and the Fed and things like that. Everyone has their own opinion on it. My personal opinion is generally that I think we're over the worst of it, just from what I can see, but I'm not a macro expert. I've got absolutely no idea when it comes to that sorts of stuff. But from what I've read and the experts that I have read, and from what I'm seeing, it does seem like we're over the worst of both inflation, at least in the US, and also shock from the rates going up. I think everyone expects the rates to go up for a little bit now. I don't think anyone expects any shock rate rises unless inflation is still really high. But from what I've seen, the next month's inflation numbers in the US should be less than last month and the month before, and the trend is still down on it as well. But as I said, not an expert on macro environment, and because of that, I actually don't really think about that too much when it comes to my ETH purchases. I purchase ETH or like crypto generally on a relative basis to where it is. I think right now, as I've mentioned plenty of times, the market and just crypto in general is in the period that we were in 2019, where everything's dead, sentiment's in the shitter, everyone's just like accepted the reality of the situation. But I think in those situations lies the most opportunity. Just like when I was selling stuff last year, I was thinking to myself, wow, okay, like the market's stupid right now. The amount of money coming in, but the amount of money that needs to keep coming in to keep the prices up at these sustained levels, not just for proof of work coins, but all these other coins that were vesting out, all these tokens. When I did the math on that, I was just like, okay, this is absolutely crazy. Sentiment was crazy. It felt like everyone was getting rich. Like in those kind of scenarios, if you've been around for 3 cycles now, like I have, you look at that and you're like, okay, I get why people get kind of caught up in this, but I've been through this before, so I'm going to rely on my past self's lessons to apply that to the future me and to the current me and make sure I play defensively here. Don't feel bad if you don't know how to do that, especially if you've only been in it for 1 cycle. As I've said to you guys before, in 2013 was my first cycle. I traded away most of the Bitcoin that I bought, and then I sold in 2014 during the bear market because I was a noob. Like, I had no idea what I was doing. I'm pretty sure, if I remember correctly, I lost like 90% of what I put in during that time, just over trading and then selling it at a loss and just doing all sorts of stupid stuff. And then my second cycle was the 2017 one. I learned from the lessons of 2013. My biggest lesson was not to leave during the bear market. And then this cycle was where I got most of the reward from from my time in crypto. And as like that's a long time, guys. Like that's like 8 years, right? Not 8-9 years since then that I've had to learn those lessons. So I think that you have to learn it yourself. No one can really teach you those sorts of things. You can learn from other people, but there's a difference between knowledge and wisdom. Wisdom is definitely based on experiences. Knowledge is just based on obviously me telling you this and other people telling you this and telling that basically they're telling you their experiences. But unless you've experienced it yourself, there's a very big disconnect there. So I know that there is a mix of people who watch the show, listen to the show. You're maybe a long term, 2 to 3 cycles. Maybe you've only been through one. Whatever you are, like this, it's always the same story. There are bear periods, there are bull periods. You just need to know how to handle each of them. Regardless of the amount of money you have put into crypto or the amount of money you've made from crypto, it doesn't matter. Like that's actually shouldn't factor into it at all. What factors into it is knowing how to handle the cycles and knowing how to profit from them. But I'm not giving trading and investment advice on this channel. All I'm trying to do is say that you need to stick around, you need to learn for yourself, you need to think for yourself, and you need to be prepared for a variety of different outcomes. And it never hurts to take profit, guys. Like honestly, I know it might be hard during bull markets to do that. I know that you may regret it because the price is going up, but the bigger regret is not taking any profit and then losing because maybe you get scared in the bear market and sell and you're like, holy shit, like everything seems really, really bad right now. I've got to sell, right? Like I've been through this. I know how that feels. It's not a good feeling. So just that a little bit of it, a little bit of advice going into the weekend, a little bit of bullishness on ETH going into the weekend. But on that note, that's going to be it for today. So thank you everyone for listening and watching. Be sure to subscribe to the channel if you haven't yet. Give it a thumbs up, subscribe to the newsletter, join the Discord channel, and I'll catch you all next week. Thanks everyone.